Welcome to the Balancing Act podcast with Singer Lewack. This month's episode kicks off the Navigating Tax Season series and will be about maximizing your deductions, a guide for individuals. We will explore essential steps for preparing for tax season, share tips and tricks for organizing financial documents, and discuss common deductions and credits available for individuals and families. We'll also provide a comprehensive checklist to help you gather all necessary documents for tax filing and introduce to you our tax team, who are here to support you throughout the tax preparation process. Let's get started and ensure you're well prepared for a smooth tax season.
All right, so let's get into the topic for today's episode, which is tax preparation steps that individuals and families can take.
Step one is kind of to use your tax organizer so you know what documents we're expecting to see. You don't have to fill it out completely, although if you want to, we certainly would encourage that. The first several pages are questions, and those are really important to answer. They give us a lot of information on what maybe is different this year and what we could expect to see or should expect to see in your documents, things we need to flesh out a little more thoroughly. So I would definitely encourage you to use that organizer and answer the questions at the beginning.
So kind of step two, after working on your organizer, is you'll want to start gathering your tax documents for your tax preparer. So usually starting around like mid-January, you'll start to receive your tax information, such as like W-2s, 1099s, K-1s, and some other information that we'll go through later. But you'll want to start to retain that information and then send it to your tax preparer later on. One thing we might recommend you to do is to kind of store all that information in kind of one place, maybe like a file folder or something like that, or in an envelope, and then that way it'll be easier to kind of organize everything and send it all at once to your tax preparer.
I think step three is remembering that not all items will be mailed to you. Yes, Jason just talked about those tax documents that you will get, and that's important, but some things do take a little extra time and work from the taxpayer. So for example, if you're self-employed, you have books and records from your business that will need to be gathered and completed. What goes into this will depend on exactly what services you have contracted with us to provide to you. If we're preparing your books, the documentation requirement will be different than if you're preparing them yourself. The important takeaway here is to allow yourself sufficient time to complete those tasks, whatever they are. It's also important to note that if you are for any reason unable to do it yourself, you're overwhelmed, you've got something specific going on in your life, we can help you. So please don't hesitate to have a conversation with us about what additional services we can provide to make things easier for you.
And kind of after that, step four would be, communicating with us and sending us your tax documents if you work with us. Some of our clients like to meet in person, and that's great. And so, if you would like to do that, feel free to reach out and we'll schedule a meeting for that. Other clients that we have prefer to send us their information using our portal, and that's probably the most secure way, to get us the information. Basically, you just click a button and you're able to upload all of your documents to our portal directly. You can also, obviously email us your documents as well. The key is you want to make sure that you send us your documents kind of as early as possible. And then that way we can, start to work on your return, sooner rather than later. And then that'll give us enough time if there's any issues or kind of tax planning that we may need to discuss.
That's great. Really helpful information. I think most people sort of figure they should hang on to their tax documentation and, whether they're gathering it in one spot, like you suggested, which I actually do myself. I put it all in one spot each year as they start to arrive. Everyone probably thinks maybe I should just hang on to this and, once I have everything, I should send it over. But really, if you're waiting for just one or two things, sending over the bulk of the documentation so our team can get started would really be the way to go, don't you think?
Oh, absolutely. Avoiding that bottleneck that we get right near the deadline is really essential for you getting your tax return product back timely, and for us getting it completed timely. So, yeah, please, if you just waiting for one or two things, send it in sooner rather than later.
Let's go on to another topic, which is tax deductions. I think most people are vaguely familiar with the concept of deductions, but there's probably some they're missing. People probably they think, oh, that's a write-off. Can you tell us a little bit about some of the common deductions that can be taken, and maybe some differences that have happened in the last few years on deductibility of some items?
Absolutely. The most common deduction for individuals these days at the federal level is the standard deduction. This is what's allowed to everyone, regardless. And the Tax Cuts and Jobs Act of 2018 kind of supersized this deduction for federal purposes, making it more advantageous for most taxpayers. In 2024, for example, the standard deduction is $14,600 for single filers and $29,200 for married filing joint filers, $21,900 for head of household filers. In order to itemize your deductions, they have to be higher than the standard deduction, which for a lot of people is just not happening right now. So taking the standard deduction precludes receiving a benefit for any of those other things referred to as itemized deductions, with a few exceptions that we will cover. However, it's important to remember that even if the larger standard deduction is utilized for federal purposes, you don't have to use that for state purposes. And most states did not conform to that 2018 legislation and have a much smaller standard deduction. So what we want to do is maximize your benefit for both federal and state. So unless you've otherwise been advised, it still makes sense to gather your itemized deductions and provide them to your tax professional so that the tax savings can be maximized at both of those levels. When we turn to itemized deductions, there are 5 main categories that include: number one, mortgage interest paid on your primary and possibly a secondary residence. There are limitations to the amounts that can be deducted, but this is generally the largest of the allowable itemized deductions for most taxpayers. Probably the thing that will send you over that standard deduction if you have it. Additionally, investment interest can be deducted to the extent that you have investment income. So that's another possibility in the interest area. The second area is charitable contributions. In order to be deductible, the donation must have been made before year end to a qualified organized charity, which is generally a nonprofit organization that is religious, charitable, educational, scientific, or literary in purpose, or that work to prevent cruelty to children or animals. War veterans organizations, domestic fraternal societies, certain nonprofit cemeteries. The United States or any subdivision of the U.S. territories, you can contribute to the government voluntarily, not via taxes, and they will allow you to deduct that.
That's interesting. They would. I suppose they would allow that, wouldn't they? They'd like that.
Yes, yes, they're happy.
I'm going to make any charitable donations to the government beyond my tax obligations, but that is an option.
Yeah, it is. It is. And there's quite a few at the state and local level, which are still considered the subdivision or a U.S. territory. So, yeah, a lot of people donate to like school funds and stuff like that for their students. So that's definitely deductible, even though it's not technically a nonprofit charity. It is a U.S. subdivision. If you have any questions about whether your organization qualifies, you can go on the IRS website and search for that. There's a section that will help you find that out. I do want to note, though, it's important to say that individual donations to like GoFundMe campaigns or anything like that do not qualify for deduction. Neither do political contributions. Contributions for which you receive a benefit or contributions of partial interest. Additionally, the contribution of time and services does not qualify either. So there's a lot of misleading things out there, I think, from some of these GoFundMe campaigns and things that say, oh, this is tax deductible, but it's not. So again, if you have any doubt, go to the IRS website and see if it qualifies. Another important thing to remember is that donations in excess of $250 must be substantiated via a written acknowledgement from the charitable organization. So if you've made a contribution over $250 and you don't have this acknowledgement, you should contact the organization and request one prior to filing your 2024 return. Or if you're audited, your deduction could be denied. So that's important to note. A lot of people don't know that part. So please, it's part of your information gathering. Look at your list, and if you don't have that substantiation, reach out to the organization. Charitable contributions do not have to be cash to be deductible. Non-cash contributions are also allowed, but the rules become slightly more complicated. The allowable deduction is the fair market value of the item at the time of the contribution. And the items must be in good condition. Most organizations aren't going to give you a deduction for your socks with holes in them and stuff like that. There are also special rules and reporting requirements for donations of certain items, vehicles, including cars, boats, and airplanes, as well as aggregate non-cash contributions over 500 and then another step over 5,000. So there are definitely some more things we have to talk about if it's a non-cash contribution. Charitable contributions are limited to a certain percentage of taxpayers' adjusted gross income, and that's going to depend on what you're donating. But even if the deduction is limited, it's not lost. The unused amount carries over to next year until it's all used up. So if you have an opportunity to make a very large contribution, just because it's not a deduction completely in this year doesn't mean you're going to lose it. So it's something to think about for some of those taxpayers with, setting up charitable funds and things like that. Finally, even if you take the standard deduction, there may be an opportunity to benefit from a charitable contribution if you are over 73 and are required to take a minimum distribution from a traditional individual retirement account. This is a great tax planning opportunity for some of our seniors out there. You can direct your distribution to be sent directly from your IRA to a qualified charity, and that portion is going to be excluded from your income, and you can still take the standard deduction. So up to $100,000 can be transferred this way each year, and you get that kind of double benefit. So again, if you're a senior and you don't really need your required minimum distribution, but you have to take it legally, you can direct it to a charity and you can still take the standard deduction. So it's a win-win for people in that situation.
When you do one of those directed RMD distributions, does the individual still get a 1099-R or another form?
They do. They do get a 1099-R, and there's usually some kind of coding on there that indicates that there was a qualified charitable distribution. I will say, and Mike, you can probably speak to this better than I can, the IRS isn't always great about recognizing that, and you may get a notice from the IRS about it, but we can always clear that up. It just sometimes takes some additional correspondence with the IRS to make them understand what happened.
Yeah, that was exactly where I was going with that. I've seen it happen multiple times. It's very straightforward to clear up, but no one likes getting letters in the mail from the IRS. But that one is pretty easy to resolve. Jason, can you tell us a little bit about some of the other common deductions that people should be on the lookout for?
Yes, absolutely. So still talking about itemized deductions, another category is taxes. So you can actually deduct some taxes on Schedule A, itemized deductions. So there's several different types of taxes that are deductible. So state income taxes, real property taxes, and then the portion of your annual vehicle registration fee that is attributable as a personal property tax may also be deductible. In general, your federal income taxes are not deductible. The Tax Cuts and Jobs Act that Shannon mentioned earlier also put a limitation on individuals. They're only able to deduct up to a maximum of $10,000 for all of these items that I just mentioned. However, for state purposes, many of the states do not conform to the Tax Cuts and Jobs Act, and therefore many of the states do not also have that cap on the $10,000 deductions for taxes. However, for most state income tax purposes, you are not allowed to deduct your state income taxes as a deduction. Another area of itemized deductions is medical expenses. There are some limitations here. The main limitation is that medical expenses are generally only deductible to the extent they exceed 7.5% of your adjusted gross income. Some examples of deductible medical expenses might include, the following paid for the benefit of the taxpayers or their dependents, fees paid to doctors, dentists, surgeons, chiropractors, psychiatrists, psychologists, hospitals, residential nursing care, inpatient addiction treatment, as well as amounts paid for prescription medications, eyeglasses, contact lenses, hearing aids, false teeth, walkers, wheelchairs, and medical transportation. I think the key is, for those items, they have to be prescribed by a doctor. So also deductible are amounts paid for your insurance, like your medical insurance, dental insurance, supplemental and long-term care insurance, though the latter may be limited. Some examples of non-deductible expenses in this area would include like the portion of your medical insurance that may be covered by your employer, and then non-prescription medicines and the like nicotine patches, maybe cosmetic surgery, funeral expenses, toiletries, and then other general self-care expenses. For a comprehensive list of these items, showing both deductible and non-deductible medical expenses, you can consult with on the IRS website. They have a list. And then kind of the other area in this category is if you are self-employed and you have a net profit for the year, you may be entitled to deduct the cost of your health insurance as an adjustment to your income. So this is not an itemized deduction, but it's in a different bucket on your return. So this would mean that you can still take the standard deduction and receive this benefit potentially. And then additionally, there is no 7.5% limitation that I mentioned earlier on this type of deduction if you're self-employed. And then this would include premiums that you pay for your spouse as well as your dependents.
Great. Thanks, Jason. I just was going to add here quickly that there are kind of a bucket of other itemized deductions for federal purposes that we want to talk about quickly. These have been severely limited by the aforementioned Tax Cuts and Jobs Act. The only real remaining allowable items are gambling losses to the extent of gambling income, casualty and theft losses of income-producing property, and or casualty and theft losses, well, it wouldn't be theft, it'd be casualty losses for qualified disaster locations. So this has to be a declared disaster area for it to be deductible. Claim of rights repayments over $3,000 and federal estate tax on income in respect of a decedent. Those last two are very uncommon items. Most people aren't encountering, but if you have it, you'll know it. You will notice all allowable deductions for out-of-pocket expenses for employees and investment expenses are not listed, as these are no longer deductible for federal purposes. But again, like some of these other items, many states did not conform. So while it might not help your federal return, you may still qualify for some state benefit. While we're discussing deductions, I would be remiss if I didn't mention retirement contributions. It's not an itemized deduction, and it can be coupled with the standard deduction. And it's really one of the best tools for reducing your tax burden today without giving the money to someone else. If you're an employee, it's too late to really affect your 2024 taxes, but you can plan ahead for 2025 by contributing a portion of your income to your employer's retirement plan each pay period. It comes out a little easier when it's broken down into each pay period. And if you're under age 50, you can contribute up to $23,500. There are some limitations that are tied to your earnings, but the maximum you can contribute is $23,500 to your employer's qualified retirement plan. This often also triggers a match from your employer sometimes. So it's a good thing to consider. Those between 50 and 59 can contribute up to $31,000, and those 60 to 63 can contribute up to $34,750. So there's quite a bit of money that you can take out of your taxable income because this amount is excluded from the income reported on your W-2 for income tax purposes. If you're self-employed, you can still cash in on some of this retirement contribution, and you can still do it for 2024. So depending on what type of plan you have and what your business structure is, you can make contributions as late as October 15th of 2025 and still have them count for 2024. If you qualify for a traditional IRA contribution deduction, you can still make payments until April 15th of 2025 and have it count for 2024. So this is one of the rare areas that we can actually do something after year end to affect the prior year's tax situation. Any of these plans will ultimately work in the same way, provided they're a qualified plan and do not have a Roth designation. You're going to defer income tax on the contribution amount until the funds are withdrawn from the retirement plan. So you're keeping the money for your future use while reducing your current tax burden. The downside, of course, there's always a downside, is that you may not have immediate access to that money. If you withdraw it before you're age 59 and a half, you will not only pay income taxes on that amount, but you'll also pay a 10% federal penalty for early withdrawal. So lots of things to consider here, but again, retirement deductions are a great way to save on your current tax burden and plan for your future.
Deductions are great because they reduce your taxable income. Everyone loves that. What is something that our listeners should know about tax credits, and how is a credit different than a deduction?
Yeah, that's a great question, Mike. So tax credits are generally more valuable than tax deductions. And the reason for that is that a deduction reduces the base on which your tax is imposed, whereas a credit offsets your tax liability directly. So for example, if you have a $10,000 deduction, and you're getting a tax benefit of whatever your tax rate is multiplied by the 10,000. So if your federal tax rate is 30%, then your net benefit of having a $10,000 tax deduction would be about $3,000. Versus if you have a $10,000 tax credit, the $10,000 tax credit reduces your tax liability directly. It's a dollar for dollar reduction in your actual tax liability for the amount of the credit. So credits are very valuable. Just to walk through a few credit examples here. One of them is the Child and Dependent Care Tax Credit. So the maximum child tax credit is $2,000 per qualifying child under the age of 17 as of December 31st, 2024, which is partially refundable under certain circumstances. Dependents who do not meet the definition of a qualified child, in this instance, the credit will max out at $500 per dependent. Single parents who earn less than $200,000 and couples who earn less than $400,000 can qualify for this credit. Another example is the Dependent Care Credit. So this is a credit that ranges from 20% to 35% of the first $3,000 of care-related expenses for a single qualifying dependent, and $6,000 for two or more qualifying dependents, with a maximum allowable credit of $1,050 for one dependent and $2,100 for two or more dependents. The expenses must be incurred to allow the taxpayer to earn income to qualify for this credit.
So if you have some child care expenses that you're paying so that way you can go to work and earn your income, then those expenses might qualify for the dependent care credit?
Yes, that's exactly right. Another credit we want to kind of touch on is some educational credits. So for example, the Lifetime Learning Credit is a credit that provides it's a non-refundable credit of up to $2,000 of the cost of tuition, fees, and course materials that are paid during the year for either yourself, your spouse, or your dependents. So that's a really good credit to take advantage of. Another credit kind of in the same space is the American Opportunity Tax Credit. This is also available for certain taxpayers who provide an additional $2,500 per qualifying student per year. And the American Opportunity Credit may also be refundable in certain circumstances. To qualify for either one of these credits, you must have modified adjusted gross income of less than $90,000 for single taxpayers, or less than $180,000 for joint taxpayers.
A couple other credits we wanted to kind of cover here. The Earned Income Credit, that's one that gets a lot of news. Not that many people qualify for it, but it is out there and it's a great credit for those who do. The maximum Earned Income Credit is $7,830 for 2024, but it's based on a number of factors. The taxpayer must have some earned income, so they have to be working in some capacity. It's a credit for low income earners. So although you must be working in some capacity, you can't have too much earned income either to qualify for this credit. It's kind of a bell curve. It generates a low credit at the very low earnings end and a low credit at the higher earnings end, but the sweet spot is kind of in the middle of the range. So if you're out there doing some work, you might qualify for this credit. It's also driven, though, the amount by how many dependents a taxpayer has. So there's a lot of factors that go into this one. And again, not that many people qualify, but it's worth knowing about. The next one is the foreign tax credit. You can take a federal credit for the income, war profits, and excess profits taxes that are imposed by a foreign country or U.S. possession. You may think you don't qualify for this, but it often comes through a brokerage account. And you may not even be aware of it. So we can pull that information off of your 1099 from your brokerage account. So just keep that in mind.
I've seen that on my brokerage account statements the last few years. You know, maybe I'm invested in a mutual fund or something.
Exactly.
I get like $1 of a foreign tax credit.
Well, you know, it's $1 less you have to send to the federal government. So
exactly, that's right. Dollar for dollar credit on my tax. I love it.
Another example of a federal credit is a premium tax credit. This is a refundable credit, the purpose of which is to help low-income families pay for health insurance purchased through the marketplace. This was part of the Obamacare legislation. It's still around. It's again based on the number of factors, including income ranges, number of dependents, as well as the minimum cost of coverage in your region. So this is a little bit more complex, but again, if you're on the low income spectrum, you should definitely be asking your tax professionals about this and providing some of those items that they request so you can maximize this credit. There's a prior year minimum tax credit. So if you've paid the alternative minimum tax in the past, you may be eligible for a credit in a future year. Obviously, AMT and how the credit is determined is a whole separate podcast. But we don't want to put everyone to sleep today with that topic, but we want you to be aware that it's out there. A really popular credit recently is the clean vehicle credit. Kind of the push for electric vehicles, this has become a really common one, and the credit's been modified many times from its original version. So right now, the credit stands that it can be as much as $7,500 for a new electric vehicle and $4,000 for a used vehicle. There are some restrictions on what an eligible vehicle is, however. It must have had final assembly in North America, and it must meet some MSRP thresholds. Again, you know, it can't be too expensive, but, you know, it has to be over a certain amount to kind of hit that sweet spot. Additionally, there are battery and critical mineral components of the federal credit that must be met. And the allowable credit hinges on the taxpayer's modified adjusted gross income as well. Fewer cars now qualify, so it's important for taxpayers to do their research before they purchase. There are some websites out there that can help you. Of course, you know, the car salesmen are supposed to be giving the right information, but I would caution to take their word for it. Partly because they want to make a sale, and partly because, you know, they don't necessarily know what the most recent changes are to the clean vehicle credit. So I would certainly caution taxpayers to do their research on their own before they go looking for an EV or a clean vehicle. There are more specialized tax credits out there, but this basically covers the federal credits that are commonly seen. I don't think there's anything else we really want to touch on here, but I do want to add that many states offer credits as well that are separate from these that we've listed. So again, communicating kind of your activity through the year so that we can capture all of these is important.
Great, thanks. If you had to describe a list of the things that you would get from a perfect client, what might I be saving if I'm listening to this and I'm looking to start storing my tax records?
Yeah, it's a great question, Mike. And the organizer that we kind of discussed earlier, we provide that to our clients, and our clients can use that as kind of a checklist or a guide when thinking about which documents they need to provide to their tax professional. But just to run through some of them, if you have wages, you'll want to provide your form W-2 that you receive, and W-2G. And then, 1099s, there's a lot of different 1099s out there, and you'll typically want to retain all of them and then provide them all to your tax professional. To highlight a few common ones, 1099-INT would be issued if you have interest income. 1099 div is for dividend income. 1099G for certain government payments. And then there's a lot of other examples as well. 1099 miss is a common one, that's issued for miscellaneous income, and things of that nature. Brokerages will typically issue a comprehensive or combined 1099 that can be very large. And these 1099s, report all of your investment income, like interest, dividends, capital gains and losses, etc. And it's really important to provide this entire document, including all the supplemental statements, to your tax professional. Because there's information buried kind of in some of those pages that your tax professional will need to report on your tax return. So it's really important to provide that entire comprehensive statement. Kind of beyond the 1099s, if you have Social Security income, you'll generally receive a form called an SSA-1099. So you'll want to retain that. And then if you are an owner in a pass-through entity, such as a partnership or S corporation, then you'll generally receive a K1. It's called a Schedule K1 from the business. And you'll want to retain that and provide that to your tax professional. And for Schedule K1s, these can actually come in as late as like mid-September. And so if this is the only item that you're kind of waiting on to file your tax return, it would be important to send all of your other information, to your tax professional early so they can, file an extension and get as much done as they can so that, once the K1 comes in later on, we can just drop in the K1 and then finalize your tax return. And this will really help us kind of manage, deadline bottlenecks that we kind of talked about before.
So that's what you were talking about earlier back at the beginning of the podcast when it was, please don't wait until you've received 100% of your tax documentation for the year before you send it to us.
We're happy to receive all the information piecemeal because then we can get as much done, as early as possible, as opposed to kind of doing everything on the back end.
Yeah, that makes a lot of sense.
Kind of beyond these, if you have a Schedule C business, then we would need to know like all of your business income and expenses. And we generally do not need, all of the receipts and backup documents for your business income and expenses, but we do need like kind of the totals for the year. And specifically for expenses, we would need your expenses kind of broken out into, like the major categories. So not just one single number for your total expenses for the year, but it would have to be broken out by category. And certain items like business meals and entertainment, they have to be very clear and evident so we can treat them properly on your tax return. So we need to know what it's for and kind of a little bit more information, specific information for that type of expense. And additionally, we also will need, a detailed list of any equipment or other business property that you may have purchased throughout the year, and kind of including, a description of the item, the date you purchased it, the cost of the item, including sales tax, delivery, and installation fees. And these requirements include all business ventures that are not reported on a partnership or corporation return. So, like a Schedule C, maybe that you file for a business, or maybe like a Schedule F for farming income and activities. And then if you have more than one business, we need all of this information for each separate business activity that you have. This can be a difficult area, so if you need assistance, always feel free to reach out and we're able to help with that. Kind of another area that we see a lot is rental property. So for this, we need a detailed summary of rental property income and expenses, and we need that information by property. So for taxpayers who have, multiple rental properties, we need this information for each property separately. And then similar to kind of the business expenses discussed above, we generally do not need, all of the receipts for rental property expenses, but we do need the expenses broken out into the major categories. And for rental property specifically, we do need a list of major renovations that you may have done to the property, equipment or appliances or furniture that you may have placed in service for the property. And then finally, if you purchase a new rental property during the tax year, we will generally need a copy of the final closing statement that's provided by the escrow company.
Great, Jason. Thank you. I would just like to add some information on claiming automobile expenses for any of these businesses that Jason referred to or rental property. We will need the total number of miles driven for the year and the total number of miles driven exclusively for each business purpose. That's going to allow us to figure out what your automobile expense deduction could be using the standard mileage rates. If you're claiming a home office, in addition to the information you would normally provide, we would need amounts paid during the year for insurance, utilities, repairs, and maintenance. If this is a new home office, we'll need the square footage of the office and the square footage of the entire home. Again, you're going to get a home office percentage of the entire home for all those costs. So that would not normally be something you would provide to us unless you have a home office situation. We're also going to need to know the amount of any retirement contributions you made to an IRA or a self-employed retirement plan. Any and all forms 1098. These are kind of, Jason talked about 1099s. Those are recording income. 1098s are more recording expenses. Examples include the regular 1098, which is mortgage interest, a 1098C, which is the contribution of a vehicle, 1098E, which is student loan interest, and a 1098T, which is tuition costs for the education credits that Jason talked about. So any 1098s you receive, send those along as well. We need a detail of real property taxes paid on all of your real estate. Unlike mortgage interest, this isn't limited to just your primary residence. So any investment in real estate that you have that's not covered up in your rental properties, please provide property taxes paid on those. It may be reported on a 1098 if it was paid from an escrow account, but if it was not, it will not be. So again, this is something you need to kind of go and gather a little extra time, unfortunately, for the taxpayer, but worth it. A copy of all your vehicle registrations during the year. I believe Jason mentioned that certain portion of the vehicle registration can be deductible. So again, if you provide those registrations to us, we can get that amount out of there and know which part is going to benefit you. I talked about charitable contributions earlier. We're going to need a detailed listing of all of those made during the year. We're going to need the name of the organization, the aggregate amount of the contribution to that organization during the year, meaning you don't have to provide every single donation you made weekly to your church, for example. Just a total that you paid for the year will be fine. We'd love to have copies of any of those acknowledgement letters you received so we can keep those with your tax documents. For non-cash contributions, we're going to need a description of what items were donated and approximate fair market value. If the fair market value exceeds $5,000, you're going to need to provide a completed Form 8283 with a signature from the donee organization and the appraiser. So you're going to need a qualified appraisal for any property that's over $5,000 that you donated, unless this donation was stock. Since stock prices can be gathered on a public website, they're determined by the stock market. We can get that, and it doesn't need to be verified by an appraiser because there's a source to get that information. So, if you do transfer stock, though, we would need the broker statement showing the transfer. If you donate an automobile, we will need a copy of Form 1098C, which I mentioned previously. The IRS has kind of gotten onto that. They've started limiting what that donation is. So the 1098 is essential. If you've incurred transportation costs in connection with your charitable endeavors, you can provide us the mileage as well as any other out-of-pocket expenses you paid for your charity work. That's all deductible as charitable contributions.
Those Form 8283 requirements for the non-cash contributions requiring an appraisal to be attached, those are pretty strict. So if you're donating some property and the fair market value is over $5,000, please call us early so that way we can make sure we get everything done correctly, all the boxes checked, all the forms and everything attached to make sure you qualify for your deduction.
Absolutely, Mike. You're absolutely right. That doing that last minute is terrifying, and I'm sure we can all tell a horror story or two about that. So the earlier you get that information to us and we can get everything done, the better for that kind of donation. Jason talked about all of the medical expenses that you may have incurred. We will need a detailed summary of these amounts, including totals paid for all of those items: insurance, pharmacy, office visit fees, hospitalization, transportation, medical equipment. You can also provide your vehicle mileage driven for medical purposes, so back and forth to the doctor. A tip here: this can be a lot of gathering. So you really only need to do this if you had significant or catastrophic medical issues during the year. If you are generally healthy and seeing the doctor for regular checkups, you're likely not going to qualify for the deductions. So you don't necessarily need to waste your time gathering this information because, again, it's a lot. So I would discuss it with your tax professional if you're unsure. But I think most of us know if we've had some pretty catastrophic, unfortunate things going on, and we can provide it in that instance. Finally, we're going to need a list of estimated tax payments made during the year, including the date and the amount paid. We need this for both federal payments and state payments made. And please do include this, even if you paid what we told you to pay, because believe it or not everyone does what we recommend. So this helps us to know that you've done it, and we can get it on your tax return properly.
We really do need that documentation because just today I was able to resolve an IRS problem for one of our clients that did do what we told them to do. They made their estimated tax payment. They made it in the correct amount on time, and they wrote the right information on the front of the check, meaning their tax ID number, the form, and the year. And believe it or not, the IRS put the payment on a completely different person's tax account, which I was able to figure out because the IRS encodes some numbers on the back of the check. And I used to work at the IRS, so I know how to read those. And so luckily, we were able to call the IRS, explain what happened, show them the evidence, and they located the payment, which in this case was over $1,500,000 of our client's money that was sitting on some other person's tax account. Luckily, it didn't get refunded out to them before we solved the problem. But if our client didn't have the records here showing what was paid and a copy of the canceled check front and back, then it would have been very, very difficult for us to trace and find that payment.
Yeah, absolutely. And it seems to me, Mike, you can correct me if I'm wrong, but most notices are generated around this area. You know, the estimated tax payments don't match what went in. And so this is why we just really like to get that reinforcement that things went the way we thought they were going to go.
Yep, exactly. And, you know, if you get a notice that looks like it's missing a payment amount or the payments don't quite add up to what was expected, it could be the result of an adjustment on the prior year tax return that reduced the amount of the refund or overpayment that was applied forward to the next year. So anytime you get a notice like that, definitely send a copy over so we can dig into it and find out what's going on.
Great advice. And yeah, any notices that you get from a government agency for a prior year, if you have not previously provided them to us, please put them in with your tax documents for this upcoming year so that we can first look into the adjustment to see if it makes sense to us and if it was, you know, correct. And second, so that we can adjust your overpayment applied so that you don't get one of those notices again next year saying, hey, you know, your payments don't match what we had on file.
Sometimes people think, well, I know what I filed was correct, so the IRS will just figure it out. I don't need to do anything with this notice. And you're both laughing because you know that is just not the case. The IRS rarely just figures anything out on their own. So, you know, if you send us your notices, we'll be able to take a look and see if it's really something wrong here, and if so, how do we fix it?
You're always going to get all of your documents returned to you, so there's no harm in including something we may not need. You know, if you're not sure, stick it in there. If we need it, we'll use it. If not, we won't. But we'll give it back to you either way. So
great information. Thank you both for joining today. Thank you, Shannon. Thank you, Jason. And we will see all of you on a future episode of Singer-Lewack's Balancing Act podcast.
Thank you for joining us on this episode of the Balancing Act podcast with Singer-Lewack. We hope you found the information on maximizing deductions and preparing for tax season helpful. Remember, our tax team is here to support you every step of the way. Be sure to check out the resources and tools we provide to ensure a smooth and efficient tax season. Stay tuned for more episodes where we'll continue to provide valuable insights and tips to help you navigate your tax journey. Until next time, take care and happy filing.